Thank you once again for downloading this recording. I would like to focus now on what we call cash flow hedging. To hedge is simply to mitigate, simply to protect yourself from something that you may consider to be adverse. In the case of financial instruments, we hedge because we want to ensure that we cover ourselves from potential losses. Companies enter into hedging transactions in order to reduce business risk, where an item in the statement of financial position of future cash flow is subject to potential fluctuations in value that could be detrimental to the business. A hedging instrument may be entered into. The aim is that where the item hedged makes a financial loss, the hedging instrument would make a gain, and vice versa, reducing the overall risk. There are two types of hedges that we will focus on in this discussion. We've got what we call fair value hedges as well as cash flow hedges. Fair value hedge. This hedge, the change in value of a recognized asset or liability that could affect profit or loss. Hedging the fair value of fixed rate loan notes due to changes in interest rates can be an example there. So I think when you deal with liabilities, you would like to ensure that you minimize your liabilities, and when you deal with your assets, the hedging strategy would ensure that your assets do not undergo drastic loss in value. All right? Cash flow hedge. This hedge the risk of change in value of future cash flows from a recognized asset or liability, or highly probable forecast transaction that could affect profits. Hedging. So in the exams again, it looks like they love cash flow hedging. I'd like to encourage you to read through the disclosure components of IFRS 7. I think this is not supposed to be very difficult. Allow me to look at a question. On 1st October, we've got a question before us. This is assignment 4, cash flow hedging. Cash flow hedging. On 1st October, but One Air is a successful international airline. A key factor affecting One Air cash flow and profits is the price of jet fuel. On 1st October X1, One Air entered into a forward contract to hedge its expected fuel requirements for the second quarter of X2 for delivery of 28 million gallons of jet fuel on 31st March 20X2 at a price of that much. The airline intended to settle the contract net in cash and purchase the actual required quantity of jet fuel in the open market on 31st March 20X2. At the company's year end, the forward price for delivery on 31st March 20X2 has risen to $2.16 per gallon of fuel, $2.16 of course. All necessary documentation was set up at inception for the contract to be accounted for as a hedge. You should assume that the hedge was fully effective. On 31st March, the company settled the forward contract net in cash and purchased 30 million gallons of jet fuel at the spot price on that date of that much. Required discuss with suitable computation how the above transactions will be accounted for in the financial statements. All right, let us go to our board. Of course, it's Excel, and I'd like you to again jot down on two things. You write the following. You say, given that One Air is hedging volatility of future cash flows to buy fuel, the forward contract is accounted for as a cash flow hedge. At inception, no accounting entries are required as the cash flow's value is initially considered or assumed to be nil. Disclosure, however, should be made relating to this particular transaction. All right, so I'm going to start with the first year. At the end of year 20x1. How did we account for this particular cash flow hedge? There we go. So we'll run with the following views. Market value of the forward contract at the date of delivery is 28 million. So we restrict ourselves to the agreed value of barrels, because the extra that was bought, because we told they bought 30, the extra was not hedged for. We just restrict ourselves to the 28 million, the amount of fuel that was hedged is going to be bought for $2.16. I hope that you can see that. Alright, so when I use if I can use my figure there, you should be able to see that that's what we have. We have got a schiste. Let me increase my decimal points to, I think 2 will be okay. 2 will be fine. Alright, so that's what we have there. Next, we deal with the same. Let us deal with agreed forward contract. Value the jet fuel at an agreed forward contract price of again 28 million multiplied by the delivery price. In this case will be 2.04 as the question suggests. So again, you do the same. You say 28 by 2.04. That's what you have there. But I would like to increase again my decimals so that I retain my cents. Alright, so let us sum up, because I think in this case we are dealing with a gain of some kind. Let me just push that one as a minus for me to find out how much I'm having as a gain. So let's have that. Alright, so we'll go to 3 again. Let me just increase my decimal. Alright, so we'll go 3.36. Alright, so as at the end of X1, we've got a gain because we locked ourselves into what we call a forward contract to purchase jet fuel at $2.16 instead of at $2.04 rather, instead of 2.16. So how do we proceed? How do we account for this particular gain that we have here? It is not difficult. All you need to do is to say, well, the gain is to be recognized in other comprehensive incomes. So recognize gain in other comprehensive incomes. Alright, I was supposed to write million there. Let me just write that one, copy that one, drop it down here, push it where it belongs. And again, for your journal, you debit finance costs, not finance cost rather, but forward contract, forward contract assets. In this case we are gaining, so we've got an asset that much. So 3.36. Let me just pick that one and push it where it belongs. Alright, get that figure. Alright, again let me try it. There, push it where it belongs. Again, I'll do this in advance. Alright, I'll need to, don't I need to increase that? Okay, fair enough. So let's do some bit of work. Which account do you credit? Credit other comprehensive incomes with that particular gain. So that's how you navigate around that particular financial instrument, cash flow hedging strategy. Let me go on to the year 20x 20x2. Okay, let me just do this. Say at the end of 20x2, in this case, how do we navigate? So please again write the following. On 31st March x2, the purchase of fuel at market value of 2.19 will give rise to cost of sales charge of 65.70. Let's write that one. At the end, at the 31st March, not at the end, at 31st March 20x2, the purchase of fuel at a price of 2.19 will give rise to cost of sales of, this is 67, let me just write it, 67.5, not 67, $65.7 million. How did I find that? Again, I multiplied 30 million let me just check that weight the other side. It says gallons, all right, 30 million gallons, all right, multiplied by the delivery cost of $2.19 gives me the precise figure that you have used there. Okay, we need to put that one there. All right, after I have done that, I progress, and please write, at this point the forward contract is settled net cash at its fair value on that date. But now we want also to remember that 28 million of the 30 million gallons was hedged for. So is there any gain in the first 3 months? I think we should have. Again, we do the work like the way we did it here. Let me just get this part, all right, and I'll replicate it, somewhere down here. Say market value again. What do we have? 19. All right, let me just get that one. Market value for delivery was 19, and then what else do we have here? We have got the hedged instrument of that much. Let me just check something here. All right, fair enough. At the end of the year we had 16, but now at the date of delivery we have got 19. It is fine. Okay, so the 16 was in reference to the current year end, and then following year end 2.9. Let me just get back. So again, you do the necessary computation. We have got millions of dollars there. Let's try to see what is happening here. 28 million H4 multiplied by 2.19. How much do we have? That's a figure. What else do we have there? This figure again, similar to what we had on the other side, multiplied by that much. All right, can we increase these? Let's increase these so that we have the relevant figures. precisely. All right, so let me put this figure in brackets so that I can establish my gain. So how much is my overall gain here? My cumulative gain, I may say cumulative gain. All right, cumulative gain, you say sum up, that's a 4, but I think we can always work it out properly. The cumulative gain is 4.2. How do you proceed with that? All right, so let's write it. Say this 4.2 is an indication of a further gain on our hedging strategy. So you write this results in a further gain of 0. Let me just write that one, 0.84 million. How did I get that? Say 4.2, the cumulative gain minus previous year gain, 3.36. That is how I'm finding that figure there. Put precisions there, and also here precisions. I mean, put currency indeed. All right, so that's how I'm finding that. Now, if we have gotten that, we need now to proceed and do the journal. This time around, the journal will have about 3 accounts. So debit, cash, at 4.2, let me write a $1 million sign there. That's what we have. Then you say credit, what we call forward contract at its carrying value. How much are we going to push in there? 3.36, of course. And then we have credit again, profit or loss, with the difference. All right, let me just increase our, okay, the difference in this case will be 0.84. Again, that rounds off. Let me increase. All right, that's what we have there. Interesting. So what do we say here? The overall gain of 4.0 on the on the forward contract rather is compensated for or hedged against the increase in fuel price. The increase in fuel price. Increase in fuel price. The gain of 3.36 previously recognized in OCI is supposed to be reversed. It's supposed to be transferred to the profit or loss as a cash flow, as now this has affected the profit or loss. All right, so let us pass that journal entry. These are basic rules for your cash flow hedging. You say, let us reverse the OCI gain of $3.36 million. $3.36 million. All right, how do we do that? Again, simple. Debit, profit or loss, with the same $3.6 million, and credit, right, credit, oh, what did I say here? Let me reverse that statement. It's not supposed to be debit, it's supposed to be credit, or debit rather. Other comprehensive income, with that same figure, 3.36, and then credit profit or loss with that figure there. All right. Now let us look at the overall impact on of this particular cash flow hedging on the profit or loss in the year X2. Overall impact on profit or loss. Let us just do that and then we shall close. So I have my dollar there. What do we have? Let us recognize the fact that we have got cost of sales increasing by 30 million gallons of fuel multiplied by the delivery cost, which I saw was 2.19. We have, let me close the brackets. We should be having figure closer to what I'm going to calculate. Alright, now let me increase my decimals to 2. That's the figure there. And I'm going to push this figure. I'm going to recognize this figure as a minus by changing my figure there. Then we are seeing that in the profit or loss we recognize an additional gain, profit for X2 additional gain was 0.84. Alright, again I increase, let me increase for 3 lines twice. Next, what do we have? We have got for the profit for the period X1, year end X1 was how much? Of course, it was 3.36. Alright, so we sum up. That is the figure that we have, the overall impact of this particular hedging strategy. So now the point is, without the hedging strategy, the company would have suffered the cost buying fuel at the full price of 67.7 million, but because we hedged, we're only going to pay a reduced cost of that much. So thank you very much. This is the end of our financial instrument discussion. I hope that you will be able to come up with relevant questions. Next time when I send a video on financial instruments, I'll send one that has got an exam standard question. Thank you so very much for your attention.